When you do venture capital investing, a lot of the companies you invest in fail.
Venture capital, people tend to have short lives.
Today, we're going to explore the world of venture capital.
We're actually one of the OGs in New York venture capital.
How many generally fail, and how successful do the successes have to be to make it all worthwhile?
So it's the law of thirds.
Okay.
A third lose 100% of their money.
Gone.
Another third will not even get your capital back. So it's all down to the last third.
This sounds like gambling. So what happened for the 2 years of the dot-com?
Everybody died. It was really unbelievable. It was very hard to live through. A lot of people never came back from that.
So let's talk about that.
The zombie unicorns, right? You have so many companies that became worth $1 billion or more that eventually went back to zero. So the problem is you think you've returned your fund and you've returned zero. We looked at this and said, this is worse than the bubble in 2000. And every time something's crashing, you're always the first person I call because you seem to understand
don't know what's going on.
You seem to really get it. Yeah. Right. Markets go up, markets go down. You have to build great companies and you have to make investment through all different types of markets.
Good advice.
Generally, when you're a startup, you raise between 12 and 18 months worth of cash. I think the next couple of years, it's definitely going to be a survival of the fittest. There's AI, there's crypto, and there's blockchain, and then there's everything else.
So it went from $1 billion to 10 billion, all the way down to 500 million.
That is extremely common.
What happens?
So what happens is
Hi, this is Steve Eisman, and welcome to another episode of the Real Eisman Playbook. And today we're going to explore an entirely new topic, something we have not explored before, and that is the world of venture capital. And my guest today is my very good friend, Stu Ellman, who is a co-founder of RRE Ventures, a firm that's been around since 1994. Stu and I know each other because our sons have been best friends for a long time and went to school together. And I was thinking for a while that I really need to explore this topic. And I called Stu about a month or two ago, and I said, Stu, you got anybody who I could explore venture capital with? And he said, how about me? And I said, okay. And so here we are. So Stu, tell us a little bit about your history. Tell us about your firm. What does it do? What does it specialize in? How'd you get into this?
Sure. So RRE, we're actually one of the OGs in New York venture capital.
Oh, good term.
Exactly. So what happened was the year was 1994, and it was a particularly good year to go into venture capital. I'd gone to business school, and my best friend in business school, his name was Jim Robinson IV. And so we became really good friends. And I was trying to figure out what to do. I was pretty good in finance. I'd done like leverage buyouts and restructurings, at Dillon Reed. And I kind of enjoyed it. It was fun. But then I went to business school, and it just wasn't cool or interesting to be a banker. And Jim, who was my best friend, was very tech focused. He had run his own computer consulting firm, had worked at JP Morgan on the tech side of banking. And we were always talking about starting our own fund, starting our own firm. And 1994 was just this incredible year. It was basically the year that the internet the World Wide Web sort of came into
being.
Not existence, but being, right? So literally we decided to start our fund the month that Netscape was released as a browser.
Oh, good timing.
Yeah. So like I had my first AOL, I had the CD-ROM, it made the it took me 16 times to get the dial-up modem to work and blah, blah, blah. But the world was incredible. The world was incredibly open. So Jim and I looked at each other. So we said, you know what? This is the right time to do something in technology. I was 27 and he was 30, right? So it's not like people were about to shower money on us and say, oh, you guys have 2 years of, 2 years out of business school. Here's a bunch of money. Go spend it on an industry we don't really know anything about. But fortunately, his dad was James Robinson III.
Who had run American Express.
Who had been the CEO of American Express. And he was known as a guy, he was making actually tech investments with his own pocket, right, with his own pocketbook. And we looked at this and we said, look, this is a guy that's on the board of Bristol Myers, Coca-Cola, Union Pacific.
He has connections.
He has great relationships, yes, or he had great relationships. Unfortunately, he passed away 2 years ago. And we looked at that and said, you know what, we're young, smart, interesting guys. We know what the future of technology is. He loves technology and has phenomenal relationships with the Fortune 500. So let's start a firm that invests in companies that sell to the Fortune 500. So we did. So in 1997, we went out and we actually raised our first actual fund with institutional limited partners.
So give an idea how much smaller the industry was back then. How big was your fund?
So we were considered a huge first fund.
Back then?
Back then. It was $94 million.
$94 million?
Yes.
$94 million was considered a big, huge venture fund back then.
Because back then it was interesting, there were almost no late stage funds, right? So what you had, I remember seeing the NVCA handbook.
Outside the what?
National Venture Capital Association handbook.
Okay.
There were basically 200 firms. That was it.
In the entire country?
In the entire country. And almost none of the firms were bigger than $200 million, right? Okay. $200 million was considered a very large fund. And nobody was a late stage fund back then. Kleiner, Sequoia, IVP, all these guys that are late stage, Mayfield, they all had $150 to $200 million funds. They were sort of hard to get into those funds, and they did sort of X number of deals. There was no... It was venture capital at its core, which is not asset management fees, but you get carry when the deals cash out and they cash out, and then you make money when your LPs make money. And
so you make a percentage of the profits.
Right. You take a carry. You take 20% carry.
20% carry.
So the world was really, really different. I mean,
well, first of all, it was much smaller.
It was much, much smaller. And the other thing that people don't really understand yet is there was no seed. So what happened is seed is something that came in the early.
There was no seed?
So right now, the whole part of seed, when you started a company in the mid 90s, right? If you were, most were software companies, right? So there was no, I'm going to do a $2 million round, get my product to market, because to do an initial round to get any product to market, you had to buy hardware. Sun Microsystem servers, you had to buy racks, you had to buy software licenses from Oracle and everybody else that you needed to do. So your initial round was always like $5 million, right? So the thing is now seed rounds are $1 million to $2 million because, as soon as everything went in the cloud and software became software as a service, right? And then you could even start outsourcing the people, it became much cheaper to create a product. But originally, like you'd have an idea for a company, you'd say, I think I can create a piece of software that does this. But you had to raise $5 million.
Because of the cost of all the equipment and everything was so high.
Exactly.
Back then.
So
the seed, this is ironic in the sense that seed investing back then required more money than it does today.
Right. But the other thing is now, and it's even less now, it's even less money is needed because of AI and Cursor and the ability to, utilize AI for coding. But back then you'd raise a $5 million round, and if the market shifted or if you realized your product wasn't going to have product market fit, you would pivot and try something else because you already had your $5 million. You couldn't get rid of your hardware. You couldn't get rid of your racks. You couldn't get rid of your software licenses, et cetera.
I see. Okay. So did your firm develop a specialty?
Yes. So we were enterprise software and software that sells to the Fortune 500. So we had a lot of financial services software. We became very good at helping our companies access the people in the Fortune 500 that we knew, right?
So you had connections actually to help your companies.
Right. And so our firm sort of partially built up around developing these connections and relationships with the larger companies. But that was really the first part of it. The second part of it is we became one of the New York early stage venture capital funds, right? Because in the late 90s, there was really nobody here. There was a small firm called Edison. There was Fred Wilson's first firm, which was called Flatiron Partners, and there was us. And it worked really well because guess what? The late 90s was a fantastic, it was Bubble 1.0, right? It was a fantastic time to have your first fund in venture capital. I think we returned the whole fund in 18 months or something. It was just a great time to do it.
People don't know all this. And when you say you returned the whole fund in 18 months, what does that mean? This is your first fund.
It's our first fund. If the fund was $95 million, we returned $95 million of capital within 18 months without even having probably drawn down more than half of it at that point. So it was just, you always want to return your capital first, right? Because you make profits after you've returned the total amount of capital.
That's a very short period. So basically people got their money back
very quickly
before you even invested all the money.
Yes.
So you had a lot of successes.
It was great. But what happened after that was New York. I give a lot of credit to Mayor Bloomberg here because he looked at New York in the late 90s and he said, look, New York is financial services. New York is Wall Street. We have the brains, we have the capabilities, we have this, we should be a technology center, right? So he enlisted the New York City Partnership, created the Economic Development Council, created all these different councils and partnerships and tech councils to push forward the agenda of making New York a tech center. People now, because it's 2025, everybody's like, yeah, New York's a tech center. New York's second only to Silicon Valley. But in the late 90s, it was New York, Then it was Boston, right? Route 128.
I remember Boston. Yeah.
And then there was a scattering of Austin, Research Triangle, a bunch. And that was New York. And New York was still, when bonuses went up on Wall Street, apartment prices went up and it got harder to get into schools. And when bonuses went down, everything rode on that. And Mayor Bloomberg, and we got to be part of all these councils and partnerships. It was great. They brought Cornell Technion over to Roosevelt Island. They created partnerships with the Fortune 500. They just did a phenomenal job. And New York built itself up to become the second largest tech market in the country, which is kind of an incredible thing. And we were in a really, really good spot as a firm because we were a firm that had already been around, already had an institutional sized fund. But we also already had the experience of investing a lot of the first fund in Silicon Valley.
I see.
And Silicon Valley was just, it was leagues more sophisticated, right? Because the Valley, the CEOs, there were third-time CEOs. All the CEOs in New York were first-time CEOs. And there's a big difference. Just having had the experience of having done it out there gave you a big leg up. So, somehow, we've now been around for 31 years. We've 10 institutional funds. I've lived through 3 full crashes now.
We're going to come to that.
I know you like crashes. I'm very familiar with you. And every time something's crashing, you're always the first person I call because you seem to
understand know what's going on.
You seem to really get it. Yeah. Right. And there was one sort of around 2007 that I noticed. It. And there was one a couple of years ago, too.
So let's talk about, the go-go time started 94, great times.
96, like 96 to 99 was fantastic. I used to think to myself, because I didn't have kids yet then.
Yeah.
I used to think to myself, my kids are going to be like, where were you during the go-go years of the internet? And I'd be like, I was in Silicon Valley making investments. And I was. And it was fun. Okay. It was.
So then you had the internet bubble crashed.
Yes.
What happened to venture capital? Because of the internet bubble crash?
So
we're talking, for those young people who don't know, 2001.
Yes. So remember I said that you had to buy servers, buy hardware, buy software licenses?
Yes.
What that means is when the market crashes, you can't cut your expenses to zero.
Because you still got to pay for everything.
You still got to pay for it. So what happens now is if your company's in real trouble, you cancel the software licenses, you hand back this, right? And you can cut your burn to almost like very little, like whatever you can cut a couple of salaries to keep the thing in maintenance mode to keep going. Back then, everybody was freaked out because the market literally absolutely crashed. I remember stocks like, and I'm going to pick, I may be wrong on the number, but stocks like Yahoo went from 260 to 3, right? Yes. I mean, the numbers, like Henry Blodgett, I was I was one of the larger investors in Business Insider, right?
By the way, Henry Blodgett
got
his start at Oppenheimer. He had the office right across the hall from me.
So I love Henry. Henry was great.
Good man.
And we did really well on Business Insider because that was the first,
I didn't realize you invested in that.
I was a board member.
Okay.
It was the whole thing. It was great. I led the Series A. But it was interesting because Henry was writing about, remember the bubble? He got issues with Merrill Lynch because he was writing about the bubbles. That he had a buy on Amazon at like 260 when it went down to like 40. Yeah. So, people didn't like that as much. But what was fascinating was you couldn't cut your expenses. So all of a sudden, the complete, it was like full risk on. We're fun to anything. It was like, I remember there were companies going public that had, I was looking at the prospectuses. I was like, wow, these guys really have nothing, right? They have like an idea. They're writing the word .com and internet, and they were going public. And you remember this. They were, I think Oppenheimer took a couple of them public, right?
I'm sure we did.
They traded up. I mean, it's like the names I can't even remember. But they were trading up from like 6 to 200 on the first day, and everybody was just getting out, and they had zero revenues. And then they all crashed. When the crash happened, it crashed and completely took the air out of the thing. And the problem was the companies that were startups that hadn't yet raised enough money. Because generally when you're a startup, you raise between 12 and 18 months worth of cash. Because it's considered if you raise more than that, you're overly diluting yourself. And you should be able to raise another round after what's normally 12 and sort of on the outside 18 months of cash. The problem is when the money dries up like that, because everybody looks at the public markets as
just let me pause
these valuation part of profit.
Just for viewers understand, these startups don't make money.
No.
They have negative cash burn.
Yes.
I mean, they have cash burn, excuse me. And at some point, if the revenue is better, they'll raise more money, hopefully at a higher valuation.
Correct.
And then maybe at some point in a couple of years, they'll turn cash flow positive.
And you can be huge businesses. Amazon, if I'm not mistaken, lost money for like the first 20 years.
Yes, it did.
Right. They seem to have built a
And they were just fine.
They're just fine.
The point is that if you're a startup and you've raised your first round, you've raised, as you said, 12 to 18 months of money, and then the market crashes and nobody's investing in the sector, you got a problem because you could go bankrupt.
Right. So it was much worse back then because you couldn't break that. You had fixed costs of the servers and the hardware and the software licenses and your leases and that of at least a couple $100,000, and you couldn't get out of them.
Okay.
Right. So that was before you had any people. Now you can get, if you really need to go into like what they call hibernation cockroach mode, you can get down to, you can make money last, but it was much harder then. It is significantly easier now because everything is rented.
So what happened during basically the 2 years of the .com?
Everybody died. It was really unbelievable.
So there were a lot of bankruptcies?
Yeah. I mean, all this. It's so funny because venture capitalists never like to say they made, every venture capitalist is like, no, I sold everything just before. No, I don't have any of those companies. But you look back, from the pets.com to, in every space, every single vertical had gone from bricks and mortar to online. And the online version of everything, right, from Vitamin Shop to this.com to furniture.com, pets, you remember all the names of it. They all raised a lot of money and they all were completely unfundable. And they almost all went out of business or got bought for almost nothing.
Okay.
And sort of that was the first crash. And it was very hard to live through. People, a lot of people never came back from that.
All right. So the world emerged. What happened to VC? Let's call it 2002 through up to the crisis, 2008. What was that world like?
So that was really, for me, the New York world, right? Because that was when New York tech started to, things came back from the bottom. The difference between, I think, the last crash, the crash that we've most recently had in that one, was 18 months after that crash, things seemed kind of normalish, right? People were coming back. People felt renewed optimism. People thought, okay, this is going to be okay. People were, the stock. I mean, venture capital, as much as you don't want to say it's related to the stock market, you're always looking at the stock market, right? Because what happens is you invest in a company, right? You start to grow it. And then what do? You eventually generally either go public, and if you don't go public, you sell. So people look at what the public comparables are trading.
Of course.
Right? So if you have public comparables that are trading at 50 times revenues,
that's good.
That's really good. And if you have public comparables that just traded down 90%, that's really bad. So what happened to the stock market between 2001 and 2007? Things were moving up.
Right.
People were happy. Things were buoyant. It was risk-on world again. People came back. And for us, New York started to really, the flywheel of the ecosystem started to kick in. And Microsoft moved here, and Google moved here, and startups moved here. And, you had a bunch of really, big tech companies that were started here right about that time period. So that was like a terrific time for me. Like it was really fun to be in New York. It was as exciting as being in the Valley in the late 90s was being in New York.
Because so much action moved here.
Yeah. And it was just like, maybe it was more just geographically specific, but I knew things were going well in the Valley. But the 2007 crash, for me at least.
2008.
2008.
Let's get our dates right.
It felt like it
started in 07.
Started in 07, but ended in 08. It was a very different feeling of venture capital crash. It wasn't as bad because in 2001, the market itself didn't crash. It felt like just the technology crashed.
Well, that is actually correct. I mean, I remember 2001, bank stocks actually did very well.
It was like just this one sector that I'm in,
which is your sector,
which is my sector, which is not quite so good, right? But I'm watching this crash. But, if the rest of your money is in a mutual fund and you're watching other people, and everybody I knew wasn't, except for people in technology, people weren't losing their jobs.
Correct.
Right. So then 2007, the tech market went down, but at least in my estimation, it went down along with the rest of the market. In other words, it wasn't worse for technology than it was for anything. It was just part of the market.
Okay.
And it wasn't nearly as bad as it was in financial services or obviously mortgage backs or housing or any of those things. So it was painful to watch, right? And obviously, you turn on the TV, you'd see the sea of red. you'd see people, it was scary, right? You're having the war rooms, the Fed, all the people in the Fed were meeting. How do we save this? I literally remember waking up, I'm like, wait a minute, Bear Stearns? Wait a minute, Lehman? Like, these were companies that, were around. My very, very first job was a cold calling broker's assistant at Bear Stearns on 55 Water Street.
Wow.
So, it's, I'm like, these for, Lehman Brothers was like, wow, it's a really prestigious firm that I, would have, loved working for when I was a kid.
Mm-hmm.
So it was a shock and watching people that I'd known, sort of, because now I was a little older, right? But people even older than me that had, spent 20 years, creating significant asset value at firms like Bear and Lehman and Solomon and this and that, go to basically zero.
But that wasn't a tech story.
It wasn't a tech story, and it didn't hit us as hard. And tech was not nearly as big. I'll tell you what the harder part was. Because when you're a venture capitalist, you raise funds every 3 years.
Right.
We were raising a fund, and I remember we went to Europe, and by the time we came back, a much bigger crash had happened. And in Germany, we had all these people that were interested in investing, and the Neumarkt, which was the NASDAQ of Germany back then, had closed, they shut down while we were on the road.
That did not help fundraising.
No, that really put a pale over fundraising. We came back.
I guess you didn't raise that fund that quickly.
We raised the fund.
Did you really?
You have to raise a fund or you don't continue on.
But it was smaller.
It was slightly smaller, yeah, and it was hard. Some funds are easy to raise and some funds are just, you got to cut it out.
Hard.
Yeah, that one was hard to raise. Raising during market crashes is very difficult. And when you've been around for over 30 years, you have to raise during up markets and down markets. And you also you can't stop investing completely. I remember one of the first sort of gentlemen I knew from in venture capital was sort of one of the, eminence grace guys of Bessemer Venture Capital. His name was Neil Brownstein. Neil, if you're listening to this, I say hi. He told me when I was 27, he's like, markets go up, markets go down. You have to build great companies and you have to make investment through all different types of markets. It's not like
good advice.
Right? It was great advice, right? Because you can't. Market goes down for 6 months. You missed all the deals within a 6-month period, but you're not cashing out on it for 5 years anyway.
Got it. Okay, so let's talk about the world. So it's after the crisis, starting 2010, 11.
Your big crisis, yes.
Yes.
The Eisman crisis.
The Eisman crisis. So
the Eisman crisis.
Post that, let's talk about basically 2010 through COVID before the next crash. What's the world like? What are you guys investing in? How easy is it to make money? How hard is it to make money?
It was a pretty good market, right? Instead of
we're talking over 10 years.
Yeah, no. It was a long bull market, let's put it that way, for tech.
Right.
But what I really like to focus on is kind of the years 20, because the years I think about right now, for the most part, is 2017 to 2021.
Okay, let's go there.
Because that's when you really found a bubble market.
Right? In your world.
In my world.
Right. So let's talk about that.
It was really interesting because, I remember there weren't a lot of people, believe it or not, that had been around from the 2001 crash to make it to the 2021 crash, right? So because venture capital, people tend to have short lives. That's the other thing, right? There aren't a lot of people that are around for 30 years because either you're good enough that you make enough money and you're just out managing your own money, or you don't make it. It's a very high death rate in this industry, right? You don't make it and you ain't going to make it. If you're not good for a couple funds, you're not going to raise your third fund, you're not going to get hired by somebody else, and you go off and you end up
doing something else.
You do something else.
Okay.
So there aren't a lot of people with long institutional memories, and also because I started the firm with Jim when I was so young, I was, still able to be, able to speak into a microphone and have a podcast, 30 years later, which is not always true of many venture capitalists. So it's funny. It was very interesting having that perspective because we saw the air go out of everything. And remember I remember seeing the prospectuses in the late 90s and it was like, we're a .com, right? We're a this. We're going to grow into this.
But we have no revenue.
We have no revenues. We're losing a lot of money, and it's totally fine, right? We're ripping records, and putting them on the air, and making them digital. And by the way, we don't have the rights to do that, but it doesn't matter because we're going public and we're going to be huge. We're giving away this product for free. We're losing money every single time we sell it. I mean, I remember there was a company that was giving away PCs for free back in the late. I can't remember the name of it, but you gave away everything for free in order to get eyeballs, so that you could advertise to these people. I mean, just think about that as a business model, right? It's like we lose money, but we'll make it up on volume. Right?
Exactly.
So
but it's the internet.
But it's the internet. So, and by the way, 20 years later, how big is the internet, right? How many big, how many big winners are there on the internet? So some obviously did work. But what became fascinating in the sort of the very latter part, just pre-COVID and obviously going into
2017-ish, 18-ish,
was there became a different model of venture capital. And there were a couple of firms that looked at the numbers, and these were firms that were well written about, and they said, as long as I'm in the top couple of deals, it doesn't matter what I pay for it, right? Because that company will be such a big success. So one of the questions you had thought about asking was what percentage work, what percentage don't work, right?
Okay, so let me repeat that. So before we started, I said just one of the questions I want to ask you is, when you do venture capital investing, a lot of the companies you invest in fail.
Right.
So how many generally fail, and how successful do the successes have to be to make it all worthwhile?
So it's the law of thirds.
Okay.
A third lose 100% of their money.
Gone.
Another third, which gets to 2/3, will not even get your capital back. You'll get some 10 cents to 80 cents on the dollar back.
Okay.
Right. So those are not successes. So it's all down to the last third.
Right.
And out of those last, we do approximately 25 deals per fund, which is appropriate portfolio diversification. And what's happened is almost every fund, you have one deal that returns the whole fund.
One deal out of 25 makes it all worthwhile.
Returns the whole fund.
And the rest of the 24 are either worthless or just
So what it normally works out is you want to have a 2.5 to 3x fund. That in venture capital is successful.
2.5 to 3 times your money as a return over the duration of the whole fund.
If you have 3x funds, everybody's happy.
Okay.
Right. So if you have one deal that returns the whole fund.
I mean, when you say returns the whole fund, you mean
so if you have a $100 million
capital
fund and you have one deal that returns $100 million,
right,
you returned your fund.
Right.
So then the rest of those deals, right, should return about another 1.5x.
At least. Hopefully 2.
Yeah. And if you get to 2x over all the other deals, it's great. So, and the problem is, what you also are seeing, and you have seen, is so many companies. So there's now this thing, I forget, zombie unicorns, right? So there are all these companies. Unicorn is a company that trades at $1 billion at a private market valuation. They became known as unicorns until they became so common they're not really unicorns. Then it became sort of a deca unicorn as a unicorn. But aside from that, you have so many companies that became worth $1 billion or more that eventually went back to zero, even in the private markets before they even went public. So the problem is you think you've returned your fund, and you've returned zero
because you didn't sell it.
Because you couldn't sell it.
You couldn't sell it. All right, so let's go back. What the companies you were seeing in 2017, 18, 19, 20, what were they like?
So what was really fascinating was that a couple of firms did an analysis, and they said, well, my competitive advantage is fundraising. And by the way, if you're in that one deal, it doesn't matter what you pay for it, right? This is the antithesis of you as a value investor, which is, do I pay 20? Do I pay 30? Is 40 way overpaying? If you're in that one deal that returns 100x, it doesn't matter what you pay.
Right.
So you had a couple of firms saying, you know what, if this is a great deal, we want in it. So we're going to raise a lot. We're going to raise multi-billion-dollar funds. And if a deal is what we think is going to be one of these top-tier deals, we're going to put in a term sheet. And what happened was something I'd never seen before. So we would go out and we would normally, in our valuation metric, right, based on our firm history, deals that we would have paid approximately 20, 30, maybe stretched to 40 million valuation for the company. A couple of firms would come in and on one day of outsourced diligence put in a term sheet at 100 million.
Because
they thought it could be
this could be the unicorn.
It could be the unicorn, right?
Okay.
And what it did is it completely changed the market for venture capital, right?
How so?
Because all of a sudden, smaller funds either couldn't compete or they had to hit that price. Because in the end, if you don't hit the market price, you're not going to make any investments.
Correct.
And if you don't make any investments, you're not really in business and you're not going to make money, right? And it was one of the most fascinating things. And the thing is, it wasn't even diligence, it was outsourced diligence. So
what do you mean it was outsourced?
So our kids are 25, our kids who are friends.
Right.
All their friends worked for consulting firms, KPMG, Bain, BCG. These firms would all hire those firms
to do the due diligence.
To do one day of diligence. One day, do a write-up of diligence, send in a term sheet, a completely vanilla term sheet with, by the way, no board seat.
This sounds like gambling.
So what happened was we looked at this, and three of the partners had been around for two crashes, and there was the one. I can't say it's the only smart thing we did in our lives, but we've done a couple of things. We've done some stupid things too. But we looked at this and said, "This is worse than the bubble in 2000." And we actually.
And it was worse in the bubble in 2000, in your view, back then.
From a
Why?
valuation perspective, because you know what, we looked at our companies that had returned the whole fund, and we did an analysis and looked at them and said, if we funded them at current valuations rather than the valuations we funded them at, what would the return on our fund be? And it was terrible.
Terrible.
Right.
Okay.
So we did the only smart thing you can do, which was we sold as much as we could at the high prices.
Right.
And we just cut way back. Normally, if you've got we had a new fund in 2021. And instead, normally you'd spend your drawdowns 5 years. The bulk of the investing happens over 3 years. So generally you spend, 30% of your fund a year. But since the market was so hot, people wanted to put money faster because things were going up more and more. So you had all these people putting like 35, 40% of their funds to work at the high prices. We actually put 7% of our fund to work. It was the only thing we could do, and it was the smartest thing we could do. And I look back right now, and I say, thank God. Right, because all these guys that invested at 100 million valuation at companies that had zero revenues, 2 years later, those companies were worth 20. They were doing washout rounds.
We're going to come to that.
Yes,
okay.
sir.
So this go-go time lasts basically through COVID. And then 2022, I'll talk about it from my perspective. The Fed starts raising rates.
Yep.
And the stock market goes through a correction. Now, the S&P was down 18% for the year. NASDAQ was down, I think, 30. But the companies that were public, that in the way I think about it, that most resemble venture capital companies, which is high revenue growth, no earnings, they were down anywhere from 70 to 90%. So those are public companies.
Right. The canary in the coal mine were SPACs.
Right.
Because SPACs, we had everybody coming to us saying, raise a SPAC, do a SPAC. And we did a couple just because it was so financially attractive, right? We had companies that were, we thought were probably worth $500 million that were going to got taken out as SPACs for $1.5 billion or $2 billion. So it's kind of hard to, you're like, okay, I'm taking in $300 million of capital. It's kind of hard to turn that down. But what happened was the valuation metrics on the SPACs after the SPACs crashed blew up the venture capital market.
Okay, explain that.
So if you were a direct-to-consumer company, right, and you were normally valued, okay, I got a better one than this. Livongo.
What's that?
Livongo was a diabetes health company. And Livongo was bought for, I believe, and I'm not always perfect on the numbers, but I believe they were bought for $12 billion by Teladoc, which was trading at a much higher valuation. So what you had all these health services companies saying, okay, that's the multiple.
That's my mark.
Right. My mark is 20x revenues.
Okay.
So post them buying Livongo, Teladoc, which was the acquirer's market cap, I believe, traded down to $7 billion or $6 billion, maybe even $5 billion. Right. Okay. So there was a huge compression of valuation. So if you were
in the public markets.
So as soon as there's a compression of valuation in the public markets, people don't want to fund those private deals at what was, if you were like, okay, it's 50x revenues on a direct-to-consumer company, and now that same exact direct-to-consumer company went public either as a company or a SPAC and it's trading at less than 1x revenues. You're not going to fund that thing at 10 or 20x revenues because you're saying this isn't going to be right. Because,
but why wouldn't you fund it at 1x times revenue? Or a different company.
You would. You theoretically would if you think, but the thing is, if it's a 1x revenues, it probably won't grow fast enough. But the harder part is the fact that they already took in money at 10x revenues.
That's what I want to come.
So I want to come to that. Right. So then it becomes somebody else's
So let's talk
problem.
a little bit about accounting in your world. So, because this is something I'm sure most people don't understand. You've explained it to me before, but I really want to go through this. So let's create a hypothetical venture capital company. And let's say round one is, we'll keep it really simple, $1 billion valuation. And let's say there were 10 investors and each one takes down $100 million. And that's round one.
All right.
Okay. 2 years go by. It's still go times. And now they're raising another round. And the new valuation is $10 billion. And everybody re-ups. And so now we got a $10 billion mark. And then 2023 happens and the market collapses and this company is still burning money and it needs to raise money again, except this time now the valuation is $500 million. So it went from $1 billion to $10 billion, all the way down to $500 million.
That is extremely common.
What happens?
So what happens is the existing investors, it becomes very difficult, right? So the existing investors don't want to take, especially the ones that invested at the 10 billion valuation, don't want to admit to the fact. So the problem is private market valuations are not marked to market.
Correct.
They're marked when a new round comes in.
So let me. So in other words, the first time it's $1 billion, and then if it goes to 10 billion, you get to mark up your portfolio to 10
until there's another round. So there are two ways to do it. If you're a good venture capital firm, which a lot of us are at this point, right? You mark it down voluntarily, saying, "I know that based on public market comparables, it shouldn't be worth."
But the accounting rules don't force you to do that.
Don't force you to do that. And if you're a newer fund and you don't have a lot of powder and you need to raise your next fund, you don't want to be showing a negative 80% IRR on your fund.
Correct.
So you want to do everything you can to not. People try to not mark down their funds. So what happens is it becomes a balancing act of, is the company going to run out of money versus how much can I squeeze into this company? So here's what I mean. What people want to do is, if they believe in the company, they're going to say, I will put more money in, but I have to drag all my prior money down to the new valuation. So if I put in, I'd rather use numbers, I'm better, because people don't use it. So if I put in 5 million at a 200 million valuation, right? And now the company's worth 50.
Yeah.
I will say I will put in another 5, but a dollar for dollar, you take down my previous 5 and all 10 goes in at 50 now.
So your
so
original
there's no
investment,
markdown,
and
right?
so and what choices are given to the existing investors?
Everybody can play.
Right.
It's a pay to play. That's what these are known as.
Okay.
The problem is pay to plays get really ugly because most people don't have enough in reserve. And particularly in the go-go years, everybody's like, I don't need reserves because more and more money is going to come in and more money is going to come in. And usually you set aside 20 or 30%, max of all follow-on investments. But the problem was this crash lasted longer than any others. So what happened was this crash happened, and then 18 months later, nobody thought this would last 3.5 years. I remember speaking at one of my LP meetings. They said, how long do you think this is going to last? I'm like, this is definitely at least 2.5 years. And everybody was like, it was one of these, right? Because we're really good at like always setting aside money and making sure we have it. Like I'm a conservative. You've known me. I'm probably the most conservative financial VC that you know. And so 12 to 18 months happened. These companies ran out of money and they went back to all their investors. And they said, guess what? You got to double down or you're getting, and by the way, the way pay to play works is if you put in the money, you can make your prior money good. But if you don't put in the money, you get washed out.
What does that mean, washed out?
It means you get diluted 10 to 1 and put to common. So if you owned 10%.
So the original investments are always done in preferred equity.
Always in preferred. So if you own 10% of the preferred and you don't write a new check because you don't have the money, you then own 1% of common.
Which is basically worthless.
So what happened was that happened 18 months later. And
18 months later after
18
what?
months after 2021, the very first, when it started to go, when it all sort of crashed 80%.
Okay.
And then, so everybody went back to like, look, this is still a good company. Put in the money. This will get us another 18 months. And by then the market should turn around. And guess what happened?
It didn't turn around.
It didn't turn around. 18 months later, you went back and all the firms that squeezed out whatever money they had no more money. So then it became only those that really, really had deep pockets were able to not get washed out of these companies. And by the way, a lot of the companies you wanted to get washed out on, because sometimes after the 2 washout rounds, you looked at it and you said, that's not going to get to profitability. And the other really hard part is that a lot of companies opened their debt spigots in 2021. So they took on debt, and they took on debt with revenue covenants.
What does that mean, revenue covenant?
So they took on, I'll take on 20 million of debt, but there's a covenant that says you have to meet 80% of your revenue projections.
And if you don't?
Debt's callable.
Oh.
And when the debt's callable, there's not enough equity to put in. So then equity holders are saying, I have to put in twice my equity just to pay out the debt, and the company would still have no money.
Oh,
so you had a lot of, so many companies that raised money from, private debt providers that were at, sort of 15%. It seemed really cheap. to take on debt. But once the covenants hit and you had to repay or get pulled, it became very, very expensive. So you actually had a lot of good companies literally go down or get washed out, or all the investors washed out just because they put too much debt on at a time when debt seemed more reliable and applicable than it could be now.
So let me ask you a question just before we move on to where we are today. Would it be fair to say, given the liberality of the accounting and that you don't actually have to mark down.
Well, there are rules, right?
But you actually don't have to mark down the position until there's another round.
Well, there are now accounting rules and you get audited and there's market standards, but it is not as precise as a mark to market. You're never going to have the market telling you what it should be every day.
I see.
There's always a little bit more gray area.
Okay. So if you read the press today, all you hear about is all this money pouring into AI and everybody's venture capital is pouring money into AI. We'll come to that. What's the state of venture capital today outside of AI in your view?
There's AI, there's crypto, and there's blockchain, and then there's everything else.
Okay.
So the AI, fortunately, we've been investing in AI applications for a while, and we have a lot of crypto and blockchain investments. So we actually, I'm going to be around and kicking for a while. So,
God bless.
God bless. Exactly. I had smarter partners than I had myself. But it's very difficult because let me paint a picture for you. Everybody who became relatively senior by 2015 created their entire track record by investing in companies between 2016 and 2021.
Okay.
Right. So, and you had a bunch of people raise their own first funds because it became very easy to raise a fund because it was a go-go time. Right. So everybody raised a seed or a $50 or $70 million fund, and their DPIs, right?
What's DPI?
Their money back. Basically, cash handed back per investment, distribution per investment are almost zero. Right? They haven't handed any money back. Some of them still, so for a while, it looked like the returns were like 100%, right? Because you would do a seed round at a $10 million valuation, then some later stage guy would come in and do it at 100, still on zero revenues, and you had 100x, 10x markup.
Right.
So your IRR looked fantastic, but you didn't take any money out.
And then it
all
collapsed.
crashed. So you haven't pushed any money back. And you couldn't raise more money. So the problem is if your track record, if you've raised one or two funds, and your one or two funds are filled with stuff that was done at the high, which is all trading at 80% lower, it becomes very, very difficult to raise your second fund. The second thing is something you actually brought up without maybe meaning to, which is interest rates.
Yes.
The heyday of venture capital was really between the 90s and sort of 2021. And during those times, interest rates were very low. And I used to joke around because the senior partner, Jim Robinson III, would always talk about interest rates. And I'd be like, old man, you don't know what you're talking about, interest rates. But you know what was interesting? When the alternative was to put in a debt fund and get 2 or 3%, people were like, you know what? I'm going to put money into venture capital. It's illiquid, yes. But if it works, I can get 15 or 20%, right? And if it doesn't, it's not
maybe
as
more.
good, I get 8%, right? I get maybe more and probably won't lose that much money and it's always being handed back. Now when you can do a distressed debt fund and look to get 7 or 8%, and then you look at venture capital, which has kind of not done particularly well over the last 6 or 7 years, people aren't allocating, right? And the second issue goes back to the very first question you asked me was, what did the fund landscape look like back when you started? There were 200 firms and all the funds had less than 200 million. Now you have a lot of $15 billion venture funds, right? So it's not like, oh my God, I'm really trying to get into Sequoia when Sequoia has a $15 billion fund. Oh my God, I really want to get into A16 when, A16 thrives Sequoia. So the problem is, back in the day, you'd say you never get fired for investing in IBM. If you're in an endowment, right? And you're like, I want to have some venture exposure, take a small piece of one of these big name funds. Now, the issue is when you're investing in a $15 billion venture fund, the odds of making it a 10x fund are low just because of the size of the numbers, right? The smaller the fund, the more multiple you can get. Remember I said in our funds, you have one deal that returns a fund. When you have over a couple of $1 billion fund, you can't have one deal that returns the fund, right? You have a huge success and it returns 30% of the fund. It changes the economics completely. And then you end up making a lot more money because you're getting 2% fees and then sort of the volume of the money. So it's becoming, there's really being an institutionalization of venture capital in that, if you're an institution, you're like, I can invest in these big names that have very big funds that are very stable and I probably won't lose money. I may not have as much risk appetite as investing in some of the smaller ones, but it's a much lower risk way of doing it. And the alternative is, by the way, let's have more liquidity and less risk and go into debt funds and distressed debt funds and asset-based funds. So it's a very, you look at the fundraising picture, and the fundraising picture of venture capital is very different. What I am concerned about is to see all of those funds that got raised between sort of 2017 and 2020, how do they go out? Are they able to raise their next fund? Because venture firms don't die quickly, they die slowly.
Why is that?
Because it's not like, boom, you're out of business. You're in business, your fees go down. What happens is you end up having a fund that doesn't put any money to work or puts de minimis amounts of money to work, but still tells people they're in business. It was interesting. If you go on like Reddit and under venture capital, you see all these like analysts and associates saying, I'm really upset I'm working for this fund, but we're a zombie fund. We're not putting any money to work, but they tell people we're putting money to work. And they want us to look at deals, but we're not, I can't develop a
And
track
why aren't they
record on my
doing
own.
any deals? They don't have any money?
They don't have any money.
Because they already invested it in stuff that's down 80%.
Right. And they can't raise their new one, but you don't just shut the doors because you still have to manage the investments that you have.
Got it.
So it's, I think the next couple of years are going to be, it's definitely going to be a survival of the fittest, right? It's going to be, have people been around, have people showed that they have a track record of getting through hard times. If they only have one or two funds and they've returned almost no capital from those one or two funds over the years, it could be very difficult and those people could get washed out of the industry. So I think we went from like 200 firms to like 1,500 firms. Then we could really go back to 500 firms.
And where are we now?
I don't know. Because like I said, it's hard to tell.
It's hard to tell who's really around.
It's hard to tell who, right. Because like, it's funny when my companies go raise money, I look at this big list and I'm like, okay, let's focus on only those venture funds that have done a new deal or done 2 new deals in the last year. And it actually culls the list tremendously.
So outside of AI.
And by the way, AI is a huge thing. Is as big as the internet in terms of changing the world. It is a big.
But it sounds
deal.
like not many venture firms can participate.
Well, that's the thing is they can't. You actually need to bifurcate this, right? So the LLMs, right? Claude, Perplexity, ChatGPT. Those guys are raising billions and billions, hundreds of billions of dollars, right?
Right.
Funds like mine that are a couple $100 million, we can't play in that game, right? We don't have nearly the amount of capital. So what funds that are, I think smart about AI are doing is they're looking for application level AI and physical AI, right? So application AI is you go to a specific vertical. And by the way, the competitive advantage in the specific verticals, you have to have proprietary data and some proprietary knowledge, and you can build a very, very interesting company in AI.
Okay.
Right. So it's like if you're the medical billing expert in AI, it's not like ChatGPT or the other guys can go in and understand all of the medical billing records, and they don't have the proprietary data for that, right? Because they're busy. So you can really build a great business. You can really build a great business in terms of like import export. You can really build a great business in terms of a variety of things, but it's all about proprietary data. The problem is what you see right now is everybody comes into VC, just like everybody slapped .com on it in the 90s, everybody slaps AI on their thing right now. And it's like, geez, I need another chat bot in this space. No, absolutely not. Half the companies you see will be done by the existing LLMs without, any changes to them. So it's about, like I said, knowledge and data. There's also going to be a physical AI.
What does that mean, physical AI?
Physical AI is going to be data built into sensors and have decision making based on the data that comes from sensors. That's
sensors.
Sensors. It's really early, but it's something we're looking at.
I don't understand I explain a little bit more of that to me.
So it's like you have a sensor and you're able to determine how many people are walking into a building, and using an AI algorithm, you're able to control the electricity and or the heat based on the sensors, right?
Okay.
So it's actually really, really interesting. Physical AI is going to be particularly interesting. And by the way, there's another fascinating part that I'm really focused on right now, which is tokenization. And I would think you would be very interested in tokenization too, right? Yeah. Right? Blockchain is here to stay, right? Blockchain is big. We're really lucky. We were early investors in Ripple, we're early investors in DCG, which is Grayscale, and Paxos. So like we've seen the crypto, and my partner Jim Robinson IV, I give him all due credit. He really saw this stuff earlier than everybody else, and he's done some great investments in that space. But the tokenization of assets and cash flows based on what goes on the blockchain really is going to be the next big thing in terms of, securities. So I'm really focused on looking at it. These are really interesting spaces, right? Where you don't have to be putting, $250 million.
Give me an example of a tokenization.
So, what everybody's talking about is real estate tokenization, right? So should a building be traded as a token and on the blockchain, right? And you can sell off either the cash flows of the building rent rolls, the air rates of the rent rolls, the usage of think back to the days of CBOs and CMOs, right? What you're doing is you're parsing out the, parts of the cash flow.
And you're selling the parts of the building as pieces as opposed to the whole building.
Right? And you're putting it on the blockchain where it's, decentralized, so nobody can steal it or do anything, right? And it's sort of inviolate the way it's set up. So I think that's going to be continually fascinating. And you're catching me on like week 2, but sort of that's my next deep dive is into tokenization.
Cool.
So I'm excited about what's going on.
Okay. Stu, thank you. That was great. Thanks for being my guest.
I appreciate it. Thank you.
This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.